Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. And I'm Ed Cox with Magnolia Wealth. Today, we're going to continue on talking about the 5 pillars of financial planning, and we are now in the tax planning portion of that. We've talked about the history of taxation. We talked about Roth conversions last week, and this week we are going to discuss qualified charitable distributions. So I hope this will help. I'm going to share my screen again. Okay, here we go. Get my pointer. So 5 pillars, we've talked about that. We're in tax planning history, Roth conversions. Today will be qualified charitable distributions, and then we have tax loss harvesting next week. So what is a qualified charitable distribution? What are the rules, and how is it benefiting us taxation-wise, okay? So a qualified charitable distribution allows individuals who are 70 and a half to donate up to $100,000 to one or more charities directly from a taxable IRA instead of taking the required minimum distribution, okay? That's typically what most people are using that for. So let's look at the rules. Now, these are not all of the rules, but they're the rules that apply to most people, okay? Like most things that the IRS puts out there, there's a lot of different rules that may apply in these few little circumstances, but not in the majority. These are the majority, okay? So you must be 70 and a half at the time you request your your qualified charitable distribution. If you process a distribution prior to reaching 70 and a half, the distribution will be treated as taxable income. So we have to be careful about that. For a QCD to count towards your current year's RMD, which is your required minimum distribution, the funds must come out of your IRA by your RMD deadline, which is generally the end of the year, December 31st. Each year we have to get those RMDs out of there. All right. Funds must be transferred directly from your IRA custodian. Okay. And basically that means from whoever's holding your IRA. In our case, typically that would be Charles Schwab. So wherever the IRA is being housed, that goes directly to the charity from them. It doesn't come, if it comes to you, you can see that little note down there. If it comes to you, you take the IRA distribution out, and then you send the charity the check, it does not count. It has to go directly from your account directly to your charity, okay? And then certain charities are not eligible to receive qualified charitable distributions, including donor-advised funds, private foundations, and supporting organizations. The last sentence is important. You are not allowed to receive any benefit in return for your charitable donation. If you use your QCD to give $1,000 to a charity of your choice, and they're doing a golf tournament, and you play in the golf tournament, and let's say that $1,000 buys your team in the golf tournament, that would not count because you are benefiting from the donation. Okay, so you have to be careful about that. Okay, so here's a scenario, a couple of scenarios real quick just to show you the mechanics of this a little bit. So this is Phil's example. His annual RMD is $15,000 in scenario 1 there. He makes a $10,000 donation using his QCD, and his remaining required distribution is $5,000. So he had to take $15,000. He sent 10 to his charity. He still has 5 he has to take out. Okay. Here's an example of Phil RMD, the same $15,000. What he has to take out, he sends the full 15 to the charity. That means he has 0% income and he has no more required distribution. He has satisfied his RMD through that full QCD that he did. Okay. And then this is a example of Phil takes his entire RMD as a QCD and donates an additional amount. Okay. So he makes the 15,000 QCD, and then he says, you know what? I'm going to take a little bit extra and donate an extra 5,000. Phil's taxable RMD income is zero. Okay. And Phil further reduces his IRA balance, which could potentially reduce his future RMD amounts. Okay. Now, this is that little note down there. Now, note, none of the additional amount made as a QCD can count towards his future required distribution. So just because he went over this year, you can't add that to next year's. Doesn't work that way. Okay, so that's only for this year. So tax benefits. What is our tax benefits? In addition to giving to charity, QCD excludes the amount you donated from your taxable income, which is unlike a regular withdrawal from an IRA. Keeping your income tax lower may reduce the impact of certain tax credits and deductions, including Social Security and Medicare tax. Very important, those two, okay? So let's take a look. Here's two examples. One is not using a QCD and taking the income from your IRA, bringing it home, and then donating it. The other is sending it directly from your IRA using a QCD directly to the charity. Just use round numbers, $100,000 worth of income. They had an RMD. They had to take 10,000. So they take the 10,000, they bring that home, and then they make the charity donation of $10,000. We have a standard deduction of $28,700. Whoops. Remember, if you're in the standard deduction, most people choose standard deduction these days. It's so high. You cannot deduct standard deduction and charity donations. Why? Because you're not itemizing. You have chosen standard deduction. So this charity donation that you made doesn't count. So you do not get both deductions. Okay. Bringing your total taxable income to $81,300, which is your income plus your required distribution minus standard deduction gives you this taxable income. Okay. Now, what if we would have done the same thing? We sent the 10,000 to the charity, but instead of taking the RMD home, we sent it directly to the charity through a qualified charitable distribution. How would that look? Same income, same required minimum distribution, except we sent our RMD directly to the charity, not bringing it home. Same standard deduction. What happens? Our income is reduced by an extra 10,000 because by sending it directly to the charity, we did not have to count the RMD, or we actually could count the charity distribution on top of our standard. Okay. So the net result is a savings of $2,000, assuming a 20% tax rate. So if you had a tax rate of 20% and you were able to take the QCD out of your income and not count it, that's a $2,000 tax savings in that example. So I hope that helped. QCDs are really helpful for some people who do philanthropic donations throughout the year. And if it's something that you would like to explore more, next time you're in the office, definitely mention that. But it's something that we go over, and typically you've heard us speak about it. And there's certain situations why you may not do it or may do it, but if it's something you think that could benefit you, please mention that. But I hope this has helped. Another tax benefit or a tax strategy we can use to lower your taxable income, get you to pay no more than the law demands out of us. So hope that helped. Y'all have a great week. God bless. Be safe with the weather, and we'll talk to you next week. Bye-bye.